Good morning, ladies and gentlemen. You'll be pleased to know that I haven't brought my cookery with me. That's the big Gurkha knife. Happy New Year and Tak for det gamla. It's delightful to see so many of you here in person and also the live feed to those who are present in both Copenhagen and Stockholm. And then hopefully many more who are on the link from their home and their office and home office. I've been reduced to just 10 minutes this year. I hope that's an indication of the quality of the speakers that we've got and not a reflection of the esteem in which my colleagues hold me. But let's see. I'm afraid I must start today with a disclaimer. It's the law now. It would probably take you 10 minutes to read it, so I will assume that you are all accomplished speed readers, and I will press swiftly on. Suffice it to say, I will not be offering you any investment advice, although I am sure there are plenty of people in the room who will be more than pleased to. When we met a year ago, some of us, virtually, we were up at the studio in Oslo, we were speculating on just how high interest rates would have to rise in response to the inflation that was forecast. But then, of course, we had the shameful spectre of war in Europe once more, a war we thought was long behind us. Russia's invasion of Ukraine served up a series of surprises. First of all, we were surprised at the strength of the Ukrainian defense, and then we were surprised at the weakness and ineptitude of the Russian armed forces. And indeed, the Russians themselves were surprised by that. Of course, war then put pressure on inflation as commodity and energy prices spiked. And it turned out that the inflation wasn't transitory after all, it was here to stay, and most central banks as a result found themselves on the back foot. That in turn led to substantial interest rate hikes. Later in the year in Asia, we had the election or crowning of President Xi. It played out much as expected, and quite what that means I'm sure we're going to discuss later this morning. And the year closed with most asset classes posting negative returns for the year. There were few safe havens, even in the generally opaque private markets, and investors had to look hard to get a positive annual return. Turning then to the capital markets in greater detail, just by way of reminder for you. While global equities fell, Norwegian equities were supported, as usual, by higher oil and gas prices. Energy actually went from being 21% of Oslo Bourse to 35%. And Equinor went from being 16% of the benchmark to 23%. So much for index diversification. Of course, there were pockets of positive equity return, for example, in Latin America, also supported by energy and materials. There was significant negative return on long-dated international bonds, and here unhedged Norwegian investors actually posted a higher loss in fixed income than they did in equity. Indeed, it was probably the worst year on record for the traditional 60-40 portfolio of stocks and bonds. Inflation and central bank policies were largely to blame for much of the drop in equities, and many of the tech darlings took a big hit over the year. And I guess the sharp-eyed amongst you will have already spotted the line in the background to this slide, which is, of course, the MSCI ACWI Technology Index. Over the year, brown stocks staged a comeback, partly due to the impact of war and energy on commodities. And the winner for the year was coal, of all things. Overall, it's been quite a tough year for ESG, not because green has been bad, but because brown has been strong. And those who thought that crypto was going to provide the ideal hedge against inflation, well, they didn't really have the best year. But we did tell you several times, I seem to recall. SKAGEN's funds did not, of course, escape the market volatility, nor the drawdown in absolute performance. Although the relative picture was much better, with 3 out of our 5 equity funds ahead of their respective benchmarks for the year. Indeed, all of SKAGEN's equity funds were ahead of their benchmarks for either 3 or 5 years by the end of the year. Here, SKAGEN VEX, the Nordic Global Fund, shown in light blue, had another strong year in relative terms. Commodities and Chinese and Korean stocks were among the top contributors to excess return. Our emerging market fund, SKAGEN Kontiki, in dark blue here, outperformed its reference index despite near total drawdown in the Russian holdings. These accounted for nearly 9% of the portfolio at the start of February. And the strong recovery that followed was mainly due to an overweight in energy stocks and very strong stock picking. After the exceptional results in 2021, the year was more challenging for our global fund, SKAGEN Global, shown here in green. The portfolio companies have continued to post very solid financials, but this has not yet been reflected in their share prices. So the portfolio certainly seems to be substantially undervalued and attractive over the longer term. Turning to our small to mid-cap global fund, SKAGEN Focus, shown here in dark green, it also had a volatile year. After a strong first quarter, the fund was down both absolute and relative in the second and third quarters. However, in the last months of 2022, it staged a strong recovery, and the fund closed the year with around 2% excess return, mainly due to its Japanese exposure. High interest rates also hit the global real estate markets very hard through the year. The return for our real estate fund, SKAGEN M2, shown here in orange, was negative and behind benchmark. A lot of the underperformance can be explained by the fund's overweight in Europe, which has experienced, as I think we all know here, an especially unfavorable macro environment. Then finally, our fixed income funds. SKAGEN Warrington, shown here in black, and SKAGEN Avkastning in blue. They were not immune to the rapid increase in rates during the course of the year. However, their short interest rate duration did mean that this limited the effect somewhat. In the fourth quarter, rates fell back, and the funds could enjoy far higher running yields. This got Warrington back into positive territory by the end of the year, and Avkastning nearly flat for the whole of the year. 1 year ago, I left you with these 4 themes for those of you that joined us virtually. And I'm very pleased to report that they have developed much as expected, and indeed largely as we've hoped for. We've expanded our investment capacity with the addition of portfolio managers to a number of our funds. And we've expanded, as promised, also the client team. And that has, particularly in Norway, allowed us to provide more access to advice. And of course, that advice remains free in SKAGEN. And also the ability to have regular updates with respective client advisors. And so far, that has been taken up very well by clients, and we hope it will continue to be so. Our digital platform continues to evolve, and of course, much more is planned for this year, and I hope you will be excited to see new functionality during the course of the year and new services on that platform. We've aligned with the new regulation that is now implemented in many markets around sustainability, and we've done that in a way that certainly we believe is credible and reflects the way that we run money. And I hope that our investors will welcome that and recognize that while we are very focused on sustainability, our principal fiduciary duty remains the delivery of best risk-adjusted returns. And of course, the value winds have been blowing in the right direction, as you saw from the market slide, with the deviation between growth and value being around 20% in value's favor for the year. But of course, the winds, while they may have been supportive, they have not blown constantly, and you see that in the volatility throughout the year. To end, I'm going to leave you with just 3 reflections. Really looking forward for 2023. For us, this year is very much about consolidation and execution. The daily business of good investment processes and effective client advisory processes. That is our focus, that is what we are paid for, and that is our commitment to all of you. In particular this year, we will focus on moving many of our direct clients towards properly diversified investment portfolios. We see that too many have a product imbalance, where they are overweight to one fund versus another, very often based on recent return. And that is not the basis for the best risk-reward profile ahead. And hopefully we will be able to persuade many of the clients to move to a more diversified portfolio across SKAGEN's range of products. And of course, we will take time to celebrate this year. We have a big birthday. We're 30 years old. And we want to celebrate that with our clients, with our families, and indeed with our friends. So please watch this space, and hopefully we will see some of you during the course of the year. In closing, may I say that it does seem that we are back to the old normal. Valuation seems to matter once again, and stock selection is key. I hope you will all invest sensibly and with conviction in 2023. Ladies and gentlemen, I wish you prosperity and good health, and I do hope you enjoy our conference. Tack för mig.